Hello viewers, welcome to my channel. This is Geeta. Today we are going to see the solution of partnership insolvency. Okay, before getting into the sum, that is RTP January 26, sum number 13, we will just have a recap of realization account, cash account, and capital account, partner's capital account. See, when insolvency is there, means he is bankrupt. He is not having any money to bring in from his estate, from his home. So, what we do in the realization account, we have to prepare realization, cash account or bank account, and your partner's capital account. We transfer all the assets, including goodwill, except cash or bank, because we need that to close the company firm. Okay, so everything will be transferred to realization account, because goodwill is a, when it is appearing in the books of accounts, it means that it is a purchase to goodwill. It will be treated like an asset, other assets. Okay, then we transfer all the liabilities except the partner's loan. That account will be separately opened and get closed, including provision for bad and doubtful debts. Dissolution expenses will get debited to realization and credit to bank account. In case a partner accepts an asset for the amount for which the partner accepts it, you have to be very careful about that amount, not the book value. Whatever the amount agreed upon by the partner, for that amount, partner's capital account will get debited and realization credited. Any liability like spouse loan is paid by that partner, or any dissolution expenses are paid by the partner, then in that case, it is the responsibility of the firm to make the payment, but the partner is making payment. So instead of money goes out of bag, the partner pays it. So you have to credit the partner's capital account and debit the realization account. Okay. Then on sale of an asset, amount is realized, that will get debited into bank account and credited to realization account. Outsider's liability is paid first, then realization account is debited, bank account will get credited. In case a creditor accepts or any outside liability is settled with an asset, in that case for full settlement, then for that amount no entry, because already the asset got closed by transfer to realization, and the liability is also closed by transferring to this realization. Partner's loan account is treated separately. Separate account will get opened, and in case your partner is having a debit balance, in that case the partner's loan account will get transferred to the capital account. Otherwise, we have to keep a separate account. When your partner becomes insolvent, insolvent means having a debit balance, he is unable to bring money from his estate, then that deficiency is to be borne by the solvent partners as per procedure provided in their deed. Otherwise, in case Garner vs Murray rule is applied, in that deficiency is to be borne by solvent partners having credit balance in their capital. See, there are three partners. This partner is insolvent. He is unable to bring the amount from his own estate. Then in that case, if these two partners are having a credit balance, then it will be borne by these two in their capital ratio. At the end of the video, I will tell you that what happens when there is a, when they follow the fixed capital method or the fluctuating capital method. In case this lady is also having a debit balance, but she is solvent, she says that I can bring the amount due from my own estate, then the loss will not be borne by this lady. The loss will be borne by only the partner who is having a credit balance. Okay. If there are some more partners, then those partners who are having credit balance in their capital ratio. Now let us go into the sum. Here only 2 points are tough, otherwise everything is, I will not call it out tough. You have to understand the concept for that. If you are very clear about your concept, you will be able to do it in an easy go. Okay. So ABC or partners, their ratio is 2 is to 2 is to 1. They have given the assets, fixed assets, current assets. Cash will go to your bank account, separate cash or bank account. Advance to B means this B has to return the money to the firm. So this will go to the debit side of his capital account. Okay. Then when you come to this side, this capital account will get transferred, balance brought down will get transferred to capital account on the credit side. And C's loan account, you have to open a separate account, but here in their solution, they didn't open a separate account, but it is always better to open loan account because C is having a credit balance. He is a solvent partner. He is not nothing to pay. Suppose if it is a loan to B, then we can transfer it to, because we have to receive money from B also. Then we can transfer it to his capital account. Here there is no need. We have to keep it a separate account and make the payment from there. Okay. So I have opened SC's loan account. Then that will be balance brought down will be 25,000. When the payment is made, bank account will get credited and this account will get closed. Okay. And Mrs. A's loan account, this will of course be transferred to realization account. Creditors will also be transferred to realization account. Provision will also be transferred to realization account. First, we will see into that realization account. Fixed asset, stock, debtor, everything is transferred and it is the liability, creditors account and Mrs. A's loan account, provision for bad and doubtful debts account is also transferred. Now coming to this, the firm was dissolved on 31st March. After preparing the balance sheet, it was discovered that purchases amounting 20,000 in March 25 itself were made but not recorded in the books, though the goods were received during March itself. Goods also received, everything is done, but it is not taken into the account of books. What will be the effect if you are not taking the purchases into your books? Now we cannot do that. What should have been done? Purchases account debit to sundry creditors account should have got credited. Both the entries are not made. Not recorded means complete omission. Okay. So now we cannot operate the purchases account. But what would have been the effect of that? The See here, if it is a trading account, if you are writing, I am giving an example. Sales 300, take it as 1000 and closing stock is 50. The total comes to 350. Opening stock is 50. By mistake, I am writing 80. Instead of writing 100, 20,000 is left out, not recorded. Okay. So 80, what happens? 80 plus 50, 130 minus 350 is 220. The gross profit. This amount is distributed to the partners in their profit sharing ratio. Okay. But we have to record the purchases properly. If you write the purchases as 100 here, what happens? 150 minus 350, your profit will come down by 200. 20,000 extra profit has gone to partners capital account. Now we have to withdraw that. We have to make a rectification entry. How to make it? We have to debit their capital account and credit the creditors account because both the entries are missed out. Okay. So now capital account has to be debited. After that, we have to take the balance of the capital account after adjusting this error. Okay. So now we have to add that 20,000 here. When you transfer to realization, you have to add that 20,000 and come to the capital account. We have to write the opening balance 146,5450 and debit with that excess profit transferred on 31 March. Okay. So actual balance is 1,38,000, 46,000 and 46,000. And the advance to be is debited here. Okay. Now, now we are going to read the next point. So up to this we have done everything. We transferred to realization account. Everything is done. And creditors also we have adjusted the profit and then added. Now the assets realized 3,07,500. So go to the bank account immediately because the amount is realized in the bank. 3,07,500 for assets. Always write it in the bracket. Okay. Realization of current and fixed assets. Then the realization account. We have to go to we have debited the bank account and credit the realization account by 3,07,500. Okay. Next point is creditors were paid. You need not to do in this order. Do it in your question order. Creditors were paid after discount of 2%. Now we have to make payment. Keep it in mind for 1,45,000. So 2% is deducted. The cash discount allowed by the creditors. So we are going to make payment of only 98%. Immediately go to the bank account. So make the payment by realization account 1,42,100. Write it in bracket. Creditors paid 98%. So go to the realization account on the debit side to cash account 1,42,100. So this point is also over. The realization expenses amounted to 5,400. Expenses immediately debit the realization account and credit the bank account. Realization to bank account or cash account for realization expenses or dissolution expenses by realization account 5,400. This point is also over. If you go step by step and do both the aspects of your entry, then you will not end up in confusion. You will not end up in any trouble. A agreed to take over the loan of Mrs. A. The spouse loan is an outsider loan. It was transferred to realization account. Okay. So now A is making the payment. So A's capital account has to get credited and realization account debited to A's capital account 50,000. We have already transferred the loan of A's loan into credit side of realization. Now A's capital account will get credited. Write it in the debit side and immediately go to capital account and write on the credit side of capital account. This is 50,000. Okay. So this point is also over. Now come to the main point of insolvency. B is insolvent and his estate is unable to contribute anything. The moment B is insolvent, first what you do, step by step if you do it, there will be no issue at all. Okay, first you close the realization account. Found out how much is the total loss. And that you distribute to all the partners. I am repeating again, distribute the loss to all the partners, including insolvent partner. Okay. So first we will close the realization account. If you close the realization account, the loss comes to 1,20,000 distributed to all the partners, 48, 48 and 24. The partners' capital account will get debited and realization will get, of course, credited. So go to the capital account, debit the realization loss to all the people, including insolvent partner. Now what happens? The solvent partners will bring in cash because the insolvent partner is unable to bring his debit balance of his capital. So he will not bring any amount now. So now bank account will get debited with the amount brought in by A and C. Both are solvent partners. They brought 48,000 and 24,000. Then their capital account, he debit the bank account, credit the capital account. Okay. By cash account, they brought this much amount. Now your next work is calculate the deficiency. Ma'am, how to calculate the deficiency? First, B is insolvent. So you just total the debit total of the insolvent partner. The debit total is 68,000. Sorry, 68,000. Then see the credit balance. If there is any. Okay, here it is then 46,000. And what is the difference? That is 22,000 excess debit. That is the deficiency amount. 22,000. You can write even here. That will be borne by both the partners A and C. They are solvent partners having credit balance in their capital ratio. Now, what is their capital? Don't go with the 1,46,000 because this is excess profit. This is an entry should go through. So we made it the rectification at the end of the time we found out. So this is the balance. 1,38,000 and 46,000 is the capital balance. So total this balance, that is 184,000, 22,000 is the loss, and his share will be 138,000 divided by 184,000 multiplied by 22,000. He has to make payment of 16,500. Same way, here it is missed out. So you can write it divided by 184,000. That will come to 5,500. She will contribute 5,500 and A will contribute 16,500. Write by A's capital account, C's capital account. Now close the capital account. Here there will be nothing because the deficiency is met out by the solvent partners. These two partners we will be getting some balance carried it down 1,71,000 and 40,500. This will be paid in the bank account by A's capital account and C's capital account. If you total the bank account, it will get tally. It means that your sum is correct. Now, already told you that I'll be explaining when there is a fluctuating capital method. Fixed capital method, we have no issue. The capital is fixed, we will be taking it. But here in this, you have to keep it in mind. Don't take this amount because there was an error. So after rectifying the error, whatever the balance comes, that has to be taken care of. Okay, in case of fluctuating capital method, up to the date of dissolution. Very, very important. Up to the date of dissolution. Any interest on capital, any interest on drawing, salary, remuneration, commission, everything has to be adjusted. Then the capital has to be calculated. Hope it's very, very clear. If you enjoy my videos, please like, share, and comment. And don't forget to share my videos. And if you like to have any other video, so please leave it in your comment box. Don't hesitate to leave it. Thank you for watching my